check in on oil prices. Initially, they dipped after Al Jazeera reported that Israel had agreed to a ceasefire proposal. Al Jazeera has since deleted that tweet, saying that Israel agrees to pause fighting, now reporting that Hamas has received a ceasefire proposal in, quote, in a positive atmosphere. And so this leading to a little bit of whiplash in the oil markets, which is undoing some of its losses right now. So we'll continue to monitor that. We've got our eyes right now on the Magnificent Seven. They're all coming out with results. We'll have 5 in the last 48 hours after this afternoon passes. So investors will be looking at the top line, the bottom line, the margins. Our next guest looks at behavior. What are investors doing with this group of stock, and how can it inform you about where they could go next? And that is technical analysis. We've got Carter Braxton Worth, CEO and founder of Worth Charting. Carter, thank you so much for joining me. What's the setup like for this group? What do you make of, kind of those knee-jerk sell the news reactions yesterday? How much stock do you put in stuff like that?
Right. So we know that price action is wise, right? There's wisdom in price. The Federal Reserve knows this. They include stock prices, one of the components of the leading indicator index. And the price action, the reaction to fundamentals yesterday was poor. We have not only reaction to presumptive Fed talk, but also the earnings out of Microsoft. In particular, and Google. So today we're going to hear from Apple and the other two big ones, Meta and Amazon. Remember this, that the Magnificent Seven are still stocks, and they're not necessarily magnificent. When we sold off, everyone knows that we sold off in 2022, the S&P dropped 27%, the QQQ dropped 37%, and the Magnificent Seven dropped 47%. And so they were hardly magnificent during the rout that was the sell-off of 2022. Now, to be fair, they've recovered more than the general averages on the way back up. But is it just a beta trade? And so you see it here. This is a comparative chart. The blue line is the Magnificent Seven. It overshoots at the top, it undershoots at the bottom, and presumptively it's overshot again.
So it sounds like you're saying there could be maybe a little bit of an air pocket lower.
Absolutely. Or said differently, if one wants to allocate capital, is it right to stay aggressively overweight the blue line, the Magnificent Seven? I don't think so.
Within that, you could maybe pick at stocks that haven't kept up as much. Apple is one of them. We'll be watching for their earnings today after the bell. What does that setup look like?
Yeah, so Apple has been, it's been a real laggard. Here's something, one way to consider it. This is Apple's performance from the end of Q3 2022 to present. Apple's up basically a third of the tech sector. It's the opposite of alpha. It's a terrible, terrible performer. Another way to look at it is we have a ratio chart, and we might have that as well. It depicts Apple's relative performance as a single line. And so one could say, so what? Apple's still up 20%. But that's like saying, I got a B. If everyone else got A's, no good. Or I'm hitting 200, but everyone else is hitting 400, no good. Apple has been a very bad pick in terms of stock selection, and I don't think that's going to get better anytime soon.
There's all kinds of ways to parse it out. You can pick sections of the market like we're doing the Magnificent Seven, or you could take an even broader look. Sometimes we look at the Russell 2000 as an indicator of small caps. You're looking at some interesting chart action on the Russell 3000.
Right. So if you think about it, for years and years, and when I came into the business, people referred to the Dow Jones Industrial Average. That's quietly gone away over the last 10 to 15 years. And now the benchmark is the S&P 500 index constructed by Standard & Poor's. But remember, the Russell 3000 is it. It represents 98% of the investable U.S. equity market. So it is the S&P 500 plus another 2,500 stocks. So when one speaks of the U.S. equity market, it's not the Dow, it's not the S&P, it's not the NASDAQ 100, it is the Russell 3000 at 98% of the total. And we might have some charts of that, but what we know is it only just 2 days ago got back to its high of early January 2022, some 2 years later. And adjusted for inflation, it's still 18% below its all-time high.
What does that tell you? Because in some ways the S&P did that too, right? It did make all-time highs, but just barely where we were. We've been in this sideways market for 2 years, really.
That's right. And what it tells you is that we have obviously great concentration and great winners in super cap names. And to be fair, markets are always concentrated. Just to put this out there, the last 50 years, plus or minus, the top 10 stocks on average are about 20% weight. There are always great champions like a GE or an IBM in its era, or Exxon when it was the most valuable company, or Cisco. So again, over almost half a century, a little bit longer, the top 10 are always about 20%. But right now, the top 10 are 30%. And therein lies the issue.
Can I get your perspective on the bond market? Because this could guide a lot of things. We're seeing the yield pull back to 3.8%. Where is support or resistance for the 10-year?
Yeah, look, we're in a very, I mean, from this seat, right, one of thousands and thousands of analysts and practitioners, we are in the lower rates camp, lower oil camp, lower dollar camp, and ultimately lower stocks. And that obviously would reflect a recession. But rates, whenever you hear a mantra, maybe we can end with this, it becomes a bromide, like higher for longer. That was at 5%. And guess what? It was the exact opposite. We've plunged to 3.8. And so when you hear things like Magnificent Seven or .com, whenever something gets to be all so comfortable and believed in, usually go the other way.